Welcome back. You're watching The Money Show on ET Now. Just before the break, we were having an in-depth conversation on mid and small cap stocks and funds as well for investors who've invested in them. And well, we've seen quite a bit of them invest as per the AMFI data, like I mentioned. So, we're going to talk to now in our Meet Your Fund Manager segment one fund manager who's managed to consistently outperform the benchmarks in this space, the mid-cap space and the small-cap space. Pankaj Tibrewal, Senior VP and Fund Manager for Equities with Kotak Mutual Fund, joins us now on the show. Hi Pankaj, good evening and thanks so much for taking our time today on The Money Show. Before I get into your fund, I want to understand what your take is of what we've been seeing in mid and small caps. If we look at just from March 2020, everyone's going to be very happy, 100% return, etc. The last few days, though, it seems to have cooled off. What is your take, first up, as a mid and small cap specialist? What's your take of this fall that we are seeing and what lies ahead?
Hi, Mohan. What we are seeing is that there's been a very sharp rally since March 2020 till a few weeks back, and the rally has been quite swift. Nifty has given about 42% return. Mid-cap index has given about 80% odd return, and small cap about 100 plus odd return. So we have seen a very sharp, rally across the broader market space. From now on, to answer the question on mid and small caps, I think there are two important aspects we need to focus on and take a call which part of the cycle we are in. So first is the corporate earnings growth. So in 2020, we formed a decadal low of about 1.6% of corporate profitability to GDP. In the peak 2007-8, if you remember, it was about 7 to 8%. It was not that good quality companies were performing badly over this period, but the loss pool actually expanded and became around 2% of GDP, the loss-making companies. However, what we saw in pandemic is nothing more than a surprise and a miracle. Corporate India needs to be applauded for that. And from 1.6%, we moved to about 2.5%. And loss pool also narrowed down. If earnings expectation comes true for this year, which is about between 30 to 35%, what we are saying is that this 2.5 becomes 3.5, but still there's a lot of difference between what we saw in the last peak of about 7-8%. So from an earnings cycle perspective, we are not towards the end of the cycle, we are towards the early cycle. The second important part to take a call on the cycle first is, where are we on the investment cycle? Almost we all know for 11 years, investment cycle has been subdued. And over the last few years, government capex or government infrastructure is doing the heavy lifting. But private sector capex has stagnated almost at 5.5 lakh crore. And the household capex, which is real estate, seems to be also not doing well over the last 6-7 years. So aggregate gross capital formation has been subdued. Our expectation is that over the next 3-4 years, I think we are at the bottom of the investment cycle and things seems to be looking up now. And from here on, our sense is that corporate balance sheet is lean, household balance sheet is in quite good shape. And those two things should make sure that corporate capex starts moving higher. And even on real estate, we are seeing early signs of positive indication. And my sense is that if these two things fire out, overall the gross capital formation should be good. So when I combine the earnings trajectory plus the investment cycle, I think we are not at the peak of the cycle, which is a very, very big comfort. Now comes to valuation. After a strong rally, what we are seeing that valuation across the board have moved higher. And quite, in terms of difference between the averages of the last 10-15 years seems to be on the higher side across price to earnings, price to book, whatever we can talk about. So that's something which we need to take cognizance of. Even on the broader market space, we believe that earnings, should be good, but valuations are capturing in that, and there's a very high expectation. So the way we saw in 2003 to 8 is that in 2003 to 8, we saw that there was a completely different cycle of earnings. There was a completely different cycle on investment, but you had intermediate drawdowns in between, and which led to corrections on the marketplace. I want to recall your viewers to 2006, May, June, where markets corrected 30%, Nifty small cap by 43%. But from there on, in the next 60, 70 weeks, market again went up and covered the entire losses and made new highs. So from a valuation tactical positioning perspective, I think it's a time to be a little careful. Lower quality stocks have started to move up in the broader market space. We need to take cognizance of that. And I would urge all your viewers who are doing DIY or even investing through funds to come in with a slightly longer term horizon of at least 3 to 5 years. Don't have a very short term horizon if they're investing right now. And we would advise that invest in a staggered manner over the next 6 to 12 months because valuation seems to be on the higher side, and tactically there could be a reason for a correction.
Okay. So, when you do enter mid and small caps, ensure you have a long-term time frame, at least 3 to 5 years, going ahead. So Pankaj, largely you were pretty optimistic on what the macroeconomics are indicating, and how the economy is headed. So, and plus earnings as well, we're just at the beginning. What would be your strategy from here on when you go to pick stocks for, the emerging equity fund and the small cap fund which you manage for Kotak?
Yeah, so I think the basic framework doesn't change, which we have been managing it for more than a decade now. What is that framework? Look out for companies who have good balance sheet and cash flows, who have opportunity to, move in terms of market share towards greater opportunity. Make sure that companies are run by honest, integral promoters, and they make return on capital which is higher than the cost of equity. That framework remains at every point of time. And the other thing which we do in the mid and small cap space, because it's a very large universe, and apart from the top 100 stocks, virtually everything is your universe in the fund, which I manage across. You have to be careful that you don't make mistakes. And our sense is that by following this investment framework, mistakes are avoided. So we filter down from top and try to come at a universe of 150, 200 stocks and try to choose our, companies. The second thing I think most important is that there is a paradigm shift happening across the globe in terms of disruption, whether it's digitalization, decarbonization, across the board with different businesses, the terminal value is getting challenged. And I think it's very important while investing to look at whether the terminal value is in that sector is challenged or not for that investing company. And I think these are the few things we are, kind of constantly evaluating in our investee companies or potential investee companies whom we invest in. So I think this is an interesting time, and making sure that we write the right companies over longer periods of time, which can grow higher than the nominal GDP growth consistently. The companies which don't dilute, which have a very strong, healthy balance sheet and cash flows, and generate return on capital, which is higher than the cost of equity for a sustainable period of time. So that's the broader framework where we go and pick stocks from the mid and small cap.
And I suppose that, the strategy, the basic framework with which you pick stocks for the funds certainly seems to be working. You've been consistently, whether I look at, the longer frame, which is the right frame to look at, 3 years or 5 years, but even if you just look at 1 month, some data from Morningstar emerging over there, you managed to do better than the index, which would be closely similar to the funds that you manage. What do you think has enabled this outperformance, and how do you strive to continue delivering that for your unit holders?
So, Mobina, in investment, we believe that staying on the pitch for a longer period of time is more important rather than going every day and trying to hit for a 6 and get out. So I think that's something which is very, very important, that we try to minimize mistakes as much as possible. And that has held us in good stead over longer periods of time. The second part is that to achieve consistency is our focus, not to remain at the number one position is our focus. And when you do that, you take risk-adjusted returns calls, you take calls which are not very volatile, you take calls which are there for the longer period of time. And if you look at the churn of the portfolio, it's very minimal. We try to stay with our investee companies for longer periods of time and make sure that we ride their entire life cycle of the profit pool. So if you do these things consistently over a period, apart from following your investment framework, what it gives you is longer periods of consistency in the fund. You may have bouts of underperformance when market goes through a very sharp movement like the one which we saw in 2017, outperforming, and we didn't compromise with our philosophy. And I think those things are very, very important from our fund management perspective. And I think if we continue to follow that, I find no reason that we should disappoint the unit holders over longer periods of time.
Okay. Pankaj, I'm going to ask you a question which may sound a bit more from a personal finance perspective. But today, let's say if investors want to put money in mid and small cap funds, in your funds, what's the best way to do that? You could say, you spoke about valuations a little bit, that how some of the stocks have become a little stretched in valuations. So what's the best method to start deploying in your funds? SIP route, perhaps a STP route, or a lump sum?
So what we are recommending to investors at this moment of time is don't invest lump sum in this space today. The time to invest lump sum was last year when there was a lot of fear on the street. This is the time to look at from a STP and SIP perspective. And if market gives you an opportunity of a tactical correction, which we believe has a higher probability, that will be the time to go lump sum. And again, I repeat, this fund is not for short-oriented investors. This fund, one should invest the mid and small cap space with a slightly longer term horizon, at least 3 to 5 years, if not less. And my sense is if you have that kind of a time horizon and you stagger your investment right now, I think over a longer periods of time, you'll be positively surprised.
Well, Pankaj, thanks as always for joining us, and I'm sure what's a very enlightening session for all of our viewers. Really appreciate you taking out time.
Thank you. Thank you, Mobina, for having me on your show.
And with that, we're going to take a very short break on the show. Be right back on The Money Show.